Please confirm you can hear me clearly.
Good evening, sir. We can hear you.
Oh, that's great. All right. By way of introduction, my name is Asiwaju Dayobelo. I will be taking you performance management every Monday. Of course, we have two lecturers that will be running this performance management. In other words, I will be taking about 50% of performance management. While the second lecturer, Mr. Deji, will be taking about 50% of the syllabus too. I'm assuming this is the first lecture for PM. I'm not 100% sure, because I know the lecture has started since Saturday. As we all know, we are dealing with new syllabus. Commencing November 2025. As far as performance management is concerned, there have been little changes. Some new topics were brought into performance management. One of the new topics is corporate failure, which is the topic we are starting with tonight. Like I usually advise students, the online class, you can maximize this class and write your exam and pass at one sitting. What you need to assume first is, assume you are in a physical class. Picture your mind that I'm in a physical class now. If there is need for you to jot, take a pen and your writing material, jot down. Of course, the video will be available next day. You can watch the video. But by writing in class, by jotting down, you are being alive instead of, because some might fall to sleep. It is very possible that somebody will log on to this platform and the person is doing something else. After the day's job, it's not impossible the person is sleeping. As a lecturer, there's no way I will be able to see you in the online class. Assuming you are in the physical class, I would have called your attention to it that don't sleep. But now it's about self-discipline. It's about self-determination. So individuals, we have to define what works for me best. The lecture will run efficiently. It is now your responsibility to maximize this lecture. Now, having said that, we move straight to the business of the day. corporate failure. To appreciate this topic, why is this topic a performance issue? Obviously, a company that is underperforming is likely to experience corporate failure. We may ask ourselves, what has happened to Diamond Bank? What has happened to Heritage Bank? These are companies established to provide banking business and to generate profits to meet the expectation of the owners. Now the question is, what has happened to this company that this company were liquidated and taken over? In the banking sector today, we don't have Diamond Bank again. We don't have Heritage Bank again. We are trying to let you see the importance of this topic. It's a performance issue where a company is underperforming. With this topic, we shall be discussing what is corporate failure. What are the likely causes of corporate failure? How can we identify companies that companies are at the risk of corporate failure? As professionals, as accountants, we should be able to identify companies that are at the risk of corporate failure, companies that are underperforming. How do we identify unhealthy companies? You know, you can identify an unhealthy human being. As accountants, we should be able to determine the financial health of a company. Is this company financially healthy or financially unhealthy? These are the issues we are going to be discussing with respect to this topic. What is corporate failure? It is a known fact that every company is established for a specific purpose. Every business organization or every organization is established for a specific objective. Where a company or a business organization cannot consistently achieve its corporate objective, then we say that company is or has experienced corporate failure. If you are to define corporate failure can be defined as the inability of a corporate company to achieve satisfactory return on capital investment. I will take that again. Corporate failure can be defined as the inability of a corporate company to consistently achieve its corporate objective. Corporate failure is the failure of a company to consistently achieve sufficient profits to meet the expectation of the business owners. If that company is established to make profits, then that company must make profits consistently. It is not sufficient to say we make profits last financial year. We make profits 2 years ago. A company must consistently make sufficient returns for the providers of capital. Where a company cannot consistently make sufficient return to meet the expectation of the owners of the business, then we said the company is experiencing corporate failure. If the situation remains unchecked, the company will eventually be liquidated and the assets will be disposed. Obviously, the company will have suffered financial distress. If a company suffers financial distress, corporate failure will follow. If a company suffered financial distress, corporate failure will follow unless the company can identify the problems and provide solution to the problem. We have defined corporate failure. You know, you can look at it. A company is unable to make sufficient profits to meet the expectation of the owner. A company cannot consistently achieve its corporate objective. That is corporate failure. Just 1 minute, please. All right, let's continue. We have defined corporate failure. And we know that corporate failure will start where a company has financial distress. Now the question is, our next question is, what are the causes of financial distress? May we not be distressed financially? Now, what are the causes of financial distress? One of them is revenue failure. What is revenue failure? Where a company cannot generate revenue. where a company cannot generate revenue, that's revenue failure. Customers are not patronizing your product, revenue failure. You are losing customers, revenue failure. A company is losing sales orders, revenue failure. If a company accepts business that does not contribute to the growth of shareholders' wealth, that is revenue failure. That means the project is not financially viable. A project with negative NPV. Imagine a company accepting a business that has negative net present value. That project, that is acceptance of a business that does not contribute to the growth and wealth of the shareholders. That's revenue failure. Please. Of course, the class is being recorded. Olanrewaju. The class is automatically being recorded. At the same time, jot down if it is necessary. Let's continue.
Dr. Ashwaju, good evening, sir.
By MD. Ogami.
Well done, sir. I just come by your class to see what is going on. Well done.
Oh, that's fine. That's fine. Oh, that's fine. That's fine. It's
All
good.
right,
All right, let's go on. Cost failure. Okay, where there is revenue failure, the company will experience financial distress. Financial distress will give rise to corporate failure. Number two, cost failure. Cost failure may occur as a result of weak cost control, where you have a weak cost control system in place, or where you have inappropriate accounting policies. Imagine a company using inappropriate accounting policies, or where you have exceptional or excessive cost burden when you are running your business at higher operational cost. Imagine running your business at higher cost. That means you are running your business with some costs that are avoidable. Obviously, where the business is being run at excessive cost, that is cost failure. Cost failure will give rise to financial distress. Financial distress will result in corporate failure. Number three, failure in asset management. Failure to invest in appropriate technology. Where a company fails to invest in appropriate technological assets, that company will have asset failure management. Where a company fails to maintain adequate working capital, asset management failure. Where there is inappropriate write-off and reinvestment. You know that if you talk of depreciation, depreciation is a way of making provision for reinvestment in assets. Now, where a company have or has inappropriate write-off, you are not making enough provision for the replacement of your assets. That's a challenge. Obviously, such company will experience asset management failure. Asset management failure will give rise to financial distress. Financial distress will result in corporate failure. That means, as accountants, we must avoid failure in asset management. Number 4 reasons. Failure in liability management. The inability to manage companies' relationship with the money market. The inability of a company to manage its relationship with the money market. That's the problem. Now the question is, what is money markets? Why should company maintain cordial relationship with the money market? You know, you must be asking questions. If you are reading book, you ask questions. We are saying that the inability to manage companies' relationship with the money market, that will give rise to failure in liability management. Now the question is, what is money market? Money market is the market for short-term borrowing and lending. I'll take that again. Money market. This is the market for short-term borrowing and lending. This is where commercial banks operate. Companies can approach commercial banks to borrow money on short-term basis. You can also approach commercial banks to make investments on short-term basis. And it is a known fact that company will require borrowing as your business grows. As the business expands, you might require funding. You might require short-term funding. That means if you require short-term funding, you approach money market to take overdraft. As a company, you must maintain a cordial relationship with that money market. The inability to manage your relationship with the money market could result in liability failure, liability management failure. Also, when you obtain loan, interest rates will apply. Poor management of your interest rate risk may result in liability failure, liability management failure. As a company, as an accountant, you must be able to manage the interest rate on loan. There's interest rate risk. What is the risk? Where a company obtains loan, the company is expected to pay back the loan as agreed and to pay the interest as at when due. Failure to pay your interest may put the life of the business at risk. Lastly, we have Failure of capital management. Failure to manage your capital base. That could be a problem. That could result in financial distress. What is capital management? Where you have capitalization. A company must maintain, let me take that again. A company must maintain adequate capital base. You must avoid overcapitalization and undercapitalization. What is overcapitalization? Where a company pumps too much money to the business than what the business requires. You are injecting money to your business. You are injecting capital to your business more than what that business requires. That will be detrimental to the health of the business. Or undercapitalization, where you don't put enough capital to the business. That also could be detrimental to the financial health of your business. That will give rise to failure in capital management or failure of capital management. This failure in capital management will result in financial distress. Financial distress will result in corporate failure. Corporate failure could lead to liquidation of a company. All right. For those not joining the class, we have explained what is corporate failure. We have explained causes of financial distress. Why do companies experience financial distress? We have explained this. Our next discussion is corporate failure prediction models. Our next discussion is corporate failure prediction model. What we are trying to discuss here is how do we identify companies at the risk of corporate failure? How do we know that this company is at a risk of corporate failure? Corporate failure prediction is concerned with identifying companies that are at the risk of corporate failure before the actual failure occurs. If management can identify the signs or the symptoms of corporate failure in advance, then management should be able to take actions to deal with the problems and prevent the company from collapsing. There are two corporate failure prediction models. There are two corporate failure prediction models. We have the quantitative corporate failure prediction model. The first school of thought is the quantitative corporate failure prediction model. This school of thought argues that company fail because of financial problems. The quantitative corporate failure prediction model argues that the reasons why company fails was because the company experienced financial problems, such as poor profitability or insufficient cash. Financial problem. They are arguing that the reason why company failed was because the company has financial problems. You are not making enough profit. You are not getting enough cash. You have too much liability or too many liabilities. So they argue that company failed because of financial problems. If this argument is accepted, if this school of thought argument is true, I'm not saying it's true, but that is their opinion. The school of thought says the reasons why companies fail was because the company in question has financial problems. Now, if their position is correct, then we should be able to use financial ratios to predict company at the risk of corporate failure. Our point is taken. We are saying that if the position of the quantitative corporate failure prediction model is correct, then as accountants, we should be able to use financial ratios to predict companies at the risk of corporate failure. We can compute different ratios, such as profitability ratios. We are trying to identify if this company is at a risk of corporate failure. I can pick the company financial statement, maybe for 5 years. I can pick a company financial statement, maybe for like 5 years. I will now subject that financial statement to financial analysis using ratios. I can compute profitability ratios, such as return on capital employed. I can compute assets turnover ratio. I can compute profit margin ratio. I'm trying to look at the company's profitability performance trend. You can pick your company where you work. Take like 5 years financial statement of your company. Now, let's take 2020, 2021, 2022, 2023, 2024. 5 years. Now, test your company's profitability performance for 5 years. Is the profit performance rising every year, or is it falling? That will give you an indication of the strength of your company. You can also look at liquidity ratio, such as current ratio, acid test ratio. You are trying to test the liquidity performance of your company. Your liquidity ratio will tell you if your company has sufficient cash to meet its short-term financial obligation. The liquidity ratio will tell you if the company has sufficient cash to be able to meet its short-term financial obligation. You can test that. That is the argument of the quantitative corporate failure prediction model. We also call it financial corporate failure prediction model. The argument of this school of thought is that companies fail because of financial problems. Hence, we can use financial ratios to estimate or to evaluate the financial health of a company. All right, I can see that low creditors payment. Okay, yes. If your creditors now they are not paying you, you are making sales, you are not getting cash, your company is at risk. Those are financial reasons. All right, let's continue. You can use financial gearing. All this will give you indication of the financial health based on financial data. We have explained this. Quantitative corporate failure operation model. We talk about profitability, your cash flow, return on equity, your gearing, viability of the business. We have explained that. Now, a notable model under the quantitative financial prediction model is what we call the Z-score. Please look at this underline. Let me expand this. I want to explain this. The Z-score. A notable financial corporate failure prediction model is what we call the Z-score. The Z-score is a financial model that uses, is a financial prediction model that uses 5 financial ratios to predict companies at the risk of corporate failure. We said Z-score is a financial prediction model that uses 5 financial ratios to predict companies at the risk of corporate failure. The formula for this Z-score I want to expand this more. Look at the formula. Z-score is equal to somebody is touching my screen. That's why I'm making this mark on my screen. The formula for the Z-score is 0.012 x1 plus 0.014. Please stop touching my screen. Zero 0.014 x2 0.33 x3 0.06 x4 and plus 1.0. At times, the examiner will give you this formula, depending on what the examiner wants to achieve. At times, the examiner will give you this formula, depending on what the examiner plans to achieve. Now, your X1 represents working capital divided by total assets. Your X2, please note that. You may write it down seriously. X1 is equal to working capital divided by the total assets. X2 is retained earnings divided by your total assets. X3 is your profit before interest and tax divided by the total assets. Your X4 is market value of equity divided by the book value of total debt. Your X5 is sales divided by your total assets. When you are done computing your Z-score, When you are done with your computation, you are going to have a result. Your result will now tell you whether the company is at a risk of corporate failure or not at a risk of corporate failure. The result will tell you if the company is at a risk of corporate failure or not at a risk of corporate failure. If you compute your Z-score and you have above 2.7, look at it please. A Z-score above 2.7 is an indication that that company is not at a risk of corporate failure. If you compute your Z-score and you have above 2.7, 2.7 and above, the company in question is not at a risk of corporate failure. That means the company is financially sound. The company has financial health. The company is financially healthy. If you compute your Z-score and it's below 1.8, it's an indication that that company is at higher risk of corporate failure. Then number 3, if your Z-score is between 1.8 and 2.7, this is regarded as gray area. If your Z-score is between 1.8 and 2.7, this is regarded as the gray area, where failure is possible, but it's not at high risk. Failure is possible, but the risk is not high. It's like saying that somebody scored 50 in the exam, somebody scored 49 in the exam. What is the difference? A candidate scored 50 in the exam or 49 in the exam. What is the difference? You can unmute. What is the difference between 49 and 50 as far as the exam is concerned?
In ICAN exam.
That's a failure.
Yes.
In ICAN exam, 49 is failure, 50 is passed.
That means that person at 50 there's possibility that if you make any mistake, that person can fail. But the risk is not high. What I'm trying to say is, it's like working at the boundary of failure. Although the person has not failed, but is working at the boundary of failure. All right, there's a question on the group chat. What do you mean by book value of debt? The book value of debt, when we say book value, that is the balance sheet value. the amount stated in your balance sheet. Financial statement is prepared using book value. So the book value represents the value of the debt as stated in the balance sheet. If you want to compute the market value, it's different. The market value now, you need to now go and what is the price of the debt in the market? The examiner says, the author says use book value. All right. One major limitation of this model is that it's only consider financial performance. It uses financial ratios to measure company at the risk of corporate failure. Financial data are historical in nature. The financial statement for last year, financial statement for 2 years back. For decision making, historical data may not be relevant. So one major limitation with this model is that it focuses on financial data to assess company at the risk of corporate failure. Now, the second school of thought. The second school of thought is qualitative, non-financial prediction model. The qualitative, non-financial prediction model. Now, this school of thought argues that company fails not because of financial problem. The qualitative, non-financial prediction model argues that companies fail not because the company have financial problems. Financial problems are the consequences of corporate failure, not the main causes of corporate failure. That is the opinion of the qualitative non-financial prediction model. The argument is that, look, the main reason why company fail is not because the company have financial problems. Because financial problems are the consequences of corporate failure. In their opinion, company fail for non-financial reasons, such as poor management team. Imagine a company with a poor management team, an inexperienced managing director. Imagine a company being led by an inexperienced managing director. For qualitative prediction model, we have what we call the Argentine model. A notable model under the non-financial prediction model is the ICAN model. The ICAN model uses three main non-financial reasons to explain reasons why company fails. The ICAN model uses three main non-financial factors to explain the reason why companies fail. These three reasons are: one, management defects. Management what? Deficiency. What are management defects? We talk about the character and strength of the senior management. Defects in management structure. Management defects will include: one, look at it, that is weaknesses in management. One, we have inexperienced managing director. That's a major problem. A company being led by an inexperienced managing director or autocratic managing director. A managing director that does not consult with the staff. Nobody can approach the MD. That is management defects. Number two, failure to separate the role of chairman and chief executive officer. That is defect in management structure. The same person is the chairman, is also the chief executive officer. A passive board of directors. A board of directors that cannot contribute to the business of the organization. When we say passive, imagine having a board member that is attending a board meeting. At the board meeting, members or some members were sleeping. They are discussing about the affairs of the company, about the business life of a company. Then the directors at the meeting, some of them are sleeping, or some cannot even contribute. Passive. That is defects in management structure. You have lack of balance in the skill sets. Lack of balance in the skill sets of the management team. Let me explain that. There must be a balance in the skills of the management team. A management team will be comprised of different professionals. Look at a bank, for example. In the management team, you are going to require an IT professional who understands information technology. You are going to require a lawyer in the board. You require an accountant in the board. You require financial analyst in the board. You require somebody with marketing skills in the board. You have a weak finance director. That's management defects. Lack of management in depth. Meaning that the management does not have, the management is not sufficiently knowledgeable. Then lastly, we talk of inability to identify changes in the business environment. As a company, you must be able to identify changes in the business environment where you operate. And you must be able to respond to these changes. It's a major problem where a company cannot identify changes in the business environment and the company cannot respond to such change. The first thing is that as a business organization, you must be able to identify changes in the business environment. That is the first thing. If you identify this change, then you must be able to respond to the change. Look at the banking sector now. Compare Nigerian banking sector, what we have now in 2020, with the banking sector in 90s or in 20 years back. Before the advent of GSM, how many of us do transfer on phone? We are not even using phone. Okay, I'll explain that. Now me, all right. I'll explain that. Before the introduction of GSM, are we doing telephone banking? No. Now, we now have GSM. We have mobile phones. Now, most of us now, we do our transfer on our phone. In fact, I can't remember the last time I entered the banking hall. Now, imagine a bank without a mobile app. That a bank in Nigeria today does not have the technology to do mobile banking. That means that bank cannot identify change. And the bank will not be able to respond to the change. That bank will suffer. Because most customers, they do their transaction on their mobile apps. Except few transactions, you go to the banking hall. So a bank must be able to identify changes in the business environment. And you must be able to respond to this change. Now, a question that, what is the meaning of this 8 mark, 4 marks? Now, the model is that where a company has inexperienced managing director, we are going to award 8 points to it. It's a major problem. Look at this. The inability to identify changes is the most or the highest defect you can have. If you identify that a company cannot identify change, that means that company is a serious problem. Where a company cannot identify change, the company has inexperienced MD, that company is in a major problem. That company will fail. No two way about it. The MD is not experienced. Then the company cannot identify changes in the business environment. The model say allot 15 points to it. The higher the point shows the higher the risk of failure. Is that better now, me? So if you find yourself auditing a company, marginal failure. I've answered that question. I mean, so if you find yourself auditing a company, you can look at it. Although it's difficult to audit, that am I sure this MD is experienced? All right. Number 2 reasons why companies fail. Accounting deficiency. Or accounting defects. Accounting defects include no budgetary control. That is awarded 3 points. Where you have a company that operates without budgetary control, that means we can spend money anyhow. There is no policy on spending. No cash flow planning. You are running your business without planning your cash flow. No policy on cash flow planning. Then lastly, accounting defects, no costing system. Imagine running a company without a costing system. We don't have a system that we accumulate our costs. That will show the cost we have incurred. The higher the company score, the higher the risk of failure. Then lastly, we have errors in action, mistake that has been made, that could have been avoided. When we say errors in action, these are decisions made by a company. These are wrong decisions taken by a company that could have been avoided. These are wrong decisions taken by a company, but this could have been avoided. Please note, these three are interconnected. Once you have defects in management and you have defects in accounting system, automatically you are going to have error in action. Once there is defect in the management structure and there is defect in the accounting system, automatically wrong decision will be taken. What are these wrong decisions? Expanding the business too quickly. When you are expanding your business, we call it over trading. You start a business today, you are open like 10 branches. Expanding the business too quickly without the cash or capital resources to finance the expansion. That is over trading. Excessive borrowing, going to obtain too much borrowing, that will be wrong decision. Because a company must know the amount of debt finance to introduce into its business. Then lastly, where a company accepts big projects that turn out to be a failure, acceptance of a project that results in failure. A company should be able to carry out business and financial analysis. You should be able to carry out the evaluation of the financial evaluation of a business. All these fall under wrong decision. This wrong decision could have been avoided where you have experienced managing director, where you have a passive board of directors. Any question, please? All right. Symptoms of corporate failure. What are the signs? What are the things you are going to see? What are the symptoms of corporate failure? What are the signs you are going to see in a company that will tell you that this company is having is having corporate failure problem? One, qualified audit opinion, where the auditor qualified the audit report or the financial report of the company. What is qualified or the audit opinion? Where the auditor says, we have examined your financial record and we observe that your financial record do not show a true and fair view. That is qualified audit opinion. It's an indication that a qualified audit opinion is an indication that that company may be having problem. Number two, high staff turnover. Where staff are leaving the business, they are leaving your company, they are resigning. That could be a sign that the company is having problem. Low interest cover ratio, meaning that the company does not have sufficient profits to cover interest payments. A low interest cover ratio could be a sign of corporate failure. High operational gearing, where your fixed cost, where the fixed cost is too high. That could be a problem. Extended overdraft. You can't repay your overdraft. You are now extending it. Overdraft that should have taken like 3 months or 6 months. You now have extended overdraft. Over reliance on a single or few customers. Poor financial ratios could be a sign of corporate failure. You can pick any 5 out of these as you go for exam. Low profitability, you have other reasons. Decline in your sales. Decline in sales could be a sign that This company may experience corporate failure. Customers are not patronizing your products again. Lack of innovation and creativity. Where a company cannot create new products, you lack innovation. The business environment is dynamic. You can't remain static as a business organization. Even as an individual, we can't remain static. Inability to replace our asset as at when due will be a sign of corporate failure. If you look at it, plants, equipment, your cars, they have useful life. The inability to replace your non-current asset as at when due will be a sign of corporate failure. Loss of key employees is a sign of corporate failure. All right, we have discussed what is corporate failure. We have discussed causes of financial distress. We have explained corporate failure predictions. We have discussed symptoms of corporate failure. To round up this discussion, we look at avoiding corporate failure. If a company wants to avoid corporate failure, what do that company need to do? If you want to avoid corporate failure as a business organization, what do you need to do? What are the actions you need to follow to avoid corporate failure? We have recommended 10 commandments that the company should follow if the company wants to avoid corporate failure. Breaking any of these commandments could result in corporate failure. The 10 commandments to be observed by companies to avoid corporate failure. One, a company must have a strategy. Even as an individual, you must have a strategy to achieve your goal in life. A company must have a strategy to achieve its objective. What is strategy? Strategy is the cost of actions taken to achieve a specific objective. A company must have its unique strategy. Two, the company must have controls in place. There must be control structure. You cannot run a business without control structure. You must have controls. The HR control, the financial control, purchasing control. Number 3, the board of directors must participate, meaning that the board of directors must be active, must be actively involved in the business of the organization. Number 4, a company must avoid a system of one-man rule. There should be consultation and there should be participation. The management, the employees. Number 5, there must be management in depth. For you to be part of the management of a company, for you to be part of the management of a company, you must have required qualification, requisite knowledge, and expertise. One is qualification. Qualification alone is not sufficient. Then you are now going to go to requisite knowledge and expertise. Number 6, a company should be able to identify changes in the business environment and must be able to respond to these changes. Number 7, treat the customers as king. Always treat your customer as kings. You are not doing the customer a favor by serving the customer. The customer is doing you a favor by bringing the business to your office for transaction. Always treat your customers as the king. Number 8, do not misuse computer. As a business organization, don't misuse the computers in your disposal. As an employee, do not misuse your computer. Do not manipulate your accounts. It is not right for company to doctor his financial figures. It becomes worse if the accountants are the one doctoring the figures. When you doctor your figures, your financial figures, that means you are hiding the problem. You can only hide the problem temporarily. It is better to let people know the problems. So that you can quickly be thinking of solution. Then lastly, a company should organize to meet the needs of its employees. These 10 commandments will assist a company to avoid corporate failure. All right. We are done with the explanation as far as this topic is concerned. Any question, please? All right, there's no question. Let us look at this question too. Yes. Zoom user, your question, please.
Good evening, sir. Hello.
Yes, please.
Okay. While you were explaining symptoms of corporate failure, from your board, I noticed there's a point there that talks about creative accounting as being a symptoms of corporate failure. So I did not really understand it. So if you can throw more light.
What is creative accounting? Creative accounting is where you manipulate your accounts to achieve a specific objective. You be creative accounting. It simply means manipulating your accounting figure. Usually done when a company is in financial problem. You do creative accounting to hide some information. For example, If you dispose assets, you now add the figure to your sales revenue. Look at it. You dispose non-current assets, maybe plants. Your company is into manufacturing. You are aware that your company has been having problems. You have not made enough sales. You now go to dispose company assets. When you get the revenue, now add it to your sales figure with an intention to increase your profits. Then you are not, we call it creative accounting. Anything you do with your accounting figure that involve manipulation is called creative accounting. Is that clear, please?
Yes, sir.
All right, I want us to look at question number 2, at least to just know how to compute this. And put it here. There's one assumption in the question. I'm trying to type it there. Spread Z-score. Z-score is equal to 1.2 x1 plus 1.4 x2 plus.
Is it 1 point or 0.12x1, 0.14x2?
But what the question is assuming we create point and leave it. Yeah, we use that one that we have. Let's use ICAN, no problem. All right, let's deal with this. Now look at the question, please. Let's maintain consistency. The question says, the following data relate to 6 public companies. We have the company given A, B, C, D, E, F. We are given the sales figure, earnings before interest and tax, the working capital, total assets, total debt, retained earnings, issue share capital in brackets, £1 per share, and we have the market price per share. Requirements. Examiner says, using the Hartman Z-score formula. So for the prediction of bankruptcy, calculate the Z-score for each company and comment on your results. Requirement B, outline the usefulness and limitation of Hartman model. That is the Z-score model. Now the question is very direct. You are given 6 companies. We want to determine the financial health of this company. We want to know if any of these companies is at the risk of corporate failure. We now go to the computation. Please get your writing material. Even though the class and the material will be shared after the class, you are also better off by writing the little you can write. Suggested solution. The first thing is to get your formula. The formula for Z-score. 0.012 x1 plus 0.014. This is x2 plus 0.33. This is x3 plus 0.06. x4 plus 1.0 x5, where x1 is equal to working capital divided by total assets. Your x2. So you can also copy, is equal to retained earnings divided by total assets. Your x3 is equal to profit before interest and tax divided by total assets. Your x4 is equal to market value of equity divided by book value of total debt. Then your x5 is 6 divided by total assets. We can now go to the first company. Let's start with APSC. Please get your calculator ready. It's going to be a participating class. We start with APSC. So I'll pick X1. What is the working capital of APSC? Working capital, 176,000 divided by total assets. I'll pick it. For company A, $176,000 divided by total asset 500,000. Please work this out. Give us somebody give us
0.352.
0.35. Next, S2. We are dealing with company A first. Company A, retained earnings 104,000 divided by total assets 500. 104,000 divided by 500. Please compute.
0.208.
0.208. X3. Profit before interest and tax divided by total assets. For company A, 80,000 divided by total assets 500,000. Please divide. 80,000 divided by 500,000. What do we have?
0.16.
0.16. X4. That is market value of equity divided by total debt. Now, look at the total debt. The total debt for company A is 156,000. We now need to get market value of equity. Now look at it. The issue share capital, ₦1 per share, is 240,000. This 240,000 is the book value of equity. This 240,000 is the book value of equity. To get market value of equity, number of ordinary shares multiplied by market price per share. Look at this now. Nominal price per share is ₦1. The naira amount is 240,000. Now get number of ordinary shares.
240,000.
Total nominal value divided by nominal price per share. That means 240 divided by 1. That means number of ordinary shares in company A is 240,000 shares. We now multiply it by market price. ₦1.50. 1.5. So we can come here now. We need to compute market value. It becomes number of ordinary shares, 240,000 ordinary shares, multiplied by market price per share, ₦1 1.50. Please compute the market value of equity.
360.
360,000.
This is 360,000. That is the market value. Divided by book value of the debt. The debt is 156,000. That will give you S4.
2.307.
2.3076.
3076.
Say 2.30
76.
Okay, 2 points. We can say approximately 8. That's better.
Okay.
That's S4, not S2. Sorry. Then you can get your X5. X5 is sales divided by total assets. What is the company sales? 760 divided by 500. That is X5.
1.52.
76000 divided by 500.
1.52.
1.52. You can now return to the formula. The Z-score is equal to 0.012 multiplied by the X1. What is our X1? $0.352 multiplied by 0.352 plus 0.014. What's our S2? You can put this in brackets. Our S2 is
0.208.
This is multiplied by
0.208.
Put in brackets for convenience and to avoid error. Go to X, our X3, 0.33 multiplied by what? 0.16. Put in brackets. Plus our X4, 0.06 multiplied by 2.308. Put in brackets. Plus 1.0 multiplied by 1.25. Now, please work this out and give us the Z-score. Z-score for company A.
1.48642.
Oh, that's great. The Z-score for company A is 1.4 what?
1.486432.
1.486. Let's just approximate at this. 1.486. The rule says if the Z-score is less than 1.8, what does that mean?
Risk of failure.
High risk of failure.
Thank you. Company A is at high risk of corporate failure. That is what the model says. So your comment will be Company A, in line with Hartman Z-score principle. Give me the other one now. Your comment become APSC with a Z-score of 1.486 is at a higher risk of corporate failure. Let us test company B. Let us test company B now. You come to company B. BPSC X1, working capital divided by total assets. Let's go to company B. The working capital here is 16,000. Total assets is 600,000.
Okay.
16,000 divided by 600,000.
0.0266.
I'm coming, sir. 16,000 divided by 600,000. 0.0 what?
266.
266. 266. Go to X2. Retained earnings divided by total assets. Company B. Retained earnings 10,000. Total assets 600,000. $10,000 divided by 600,000. What do we have, please?
0.0166.
X3. Profit before interest and tax divided by total asset. This company has negative profit minus 40,000 divided by total asset 600,000. Negative 40 divided by 600,000. That will give you negative sign.
Minus 0.066.
0.066. X4. Market value of equity divided by the book value of debt. Look at the equity, number of ordinary shares. 300,000 shares because it's 1 naira per share. Multiplied by 0.2. The debt here is 290,000. So we come here. Number of ordinary shares, 300,000, multiplied by 0.2. That will give you a figure divided by total debt, 290,000. Please work this out. What do we have? 0.2 multiplied by 300,000. What do we have?
0.2066.
0.206.
Finance, Abby?
Yes.
206.
0.02. Okay?
6.
6, Abby?
Yes.
X5 sales.
That's
all
zero
over.
point 20689. Are we keeping it in 4 decimal place?
3 places. So we can take this to be 3.
That would be 7. 0.207.
That would be 0.207.
0.207.
Yes, sir.
Ew. The X5, sales divided by total asset. What is the sales in company B? 575,000. By total asset, 600,000. 575,000 divided by 600,000. 0.1.
0.5. 0.958.
958.
8.
So we can compute the Z score for company B. The Z score is equal to 0.012 multiplied by X1. What is X1? 0.0266. 0.0266, put in brackets for convenience, plus 0.014 multiplied by 0.0166. Zero point 0.0166. No, that's not correct. 0.0. 0.0166 plus bracket 0.33 multiplied by, what is S3?
0.066.
Yeah, thank you. 0.207 plus 0.06. What is X for?
It's not correct though. X3
It's not
is
correct
0
though.
minus
X3
0.066.
Oh,
is
sorry.
minus
This is 0.207. Why this is negative? This is negative. Negative 0.066, Abi?
Yes.
Then plus 1.0 multiplied by S5, 0.958. Please, you can apply your calculator at once and give us the Z score for company B. Okay, let me leave it.
0.9542.
Okay, let's take a figure first. The Z score for company B 0.9 what?
9542 is 0.954156.
Just do three decimal places. It's okay.
Okay, 954.
No, don't stress yourself too much. All right, we are done. Just to make comments. It's obvious that this company is not doing financially well. Based on Z-score model, we can say that this company is at high risk of corporate failure. Let us take company C. So I will with three company C, then you have company D, E, F. Go and attempt that question. Company C, CPSC, X1, working capital divided by total assets. For company C, the working capital is 150. Okay, there's an error here. The sales of company B is 360. We picked 575.
Instead of 360.
For company C, working capital is 150. Total asset 600. Let me take that first.
Oh, it's true. It's true.
Yes.
It's 360.
Here we should have picked, so that if you are looking at it, we should have picked 360. We should have picked 360 here. That we have set our answer here. What's the answer here now? 0.06.
06.
0.6.
0 point what?
0.6.
0 point 0.66.
0.6. 0.6.
Oh, 0.6. So you can return here and say this will now be 0.6. That will further reduce. Somebody can run through it. Our answer will change. Here, our X1 here is working capital. Working capital for company C, 150 divided by total assets, 600.
0.25.
150,000 divided by 600,000, 0.25. Go to X2. Retained earnings divided by total assets. The retained earnings here, 80,000 divided by total assets, 600,000. What do we have?
0.133.
This is 80,000 divided by 600. Answer 0. What?
133.
133.
X3. Profit before interest and tax divided by total assets. For company C, 75,000 divided by 600,000.
0.125.
75 divided by 600, 0.125. X4, market value of equity divided by book value of debt. The equity here, number of ordinary shares here. Because the price is 1 naira. Number of shares here is 180 multiplied by 2.5. Total debt, 340,000. Let's go to it. 180,000 shares multiplied by 2.5 divided by 340. What is X4? X5.
1.323.
1.324.
4.
X5. Total sales 575 divided by total assets 600. What do we have? 0.954. No, is that correct?
58.
58, Daddy.
58. Yes.
Z score for company C is equal to 0.012 multiplied by X1 The X1 here is 0.25. 0.25 plus bracket 0.014 multiplied by X2. What is X2? 0.133. 0.133 plus bracket 0.33 multiplied by X3. 0.125, 0.125 plus bracket 0.06 multiplied by x4,
1.324.
1.321
324.
It's 324.
324, sir.
Okay. 1.0 multiplied by 0.958. Please carefully work this out and give us the Z-score of company C.
1.084.
1.084. Okay, I'll put it here. Z-score is equal to 1.084.
High risk. Good.
What do you say, sir? I'm assuming the computation is correct. So,
That's correct.
all right. That's how to calculate your Z-score. You can practice with the remaining three companies. We have company D, company E, company F. To further enrich or improve your understanding. We shall stop here tonight. Any question, please?
Sir. Hello.
Yes, and we are all here. We are listening.
Okay, so based on this answer we got for C 1.08, what conclusion are we drawing?
Okay. What is the rule, please?
The rule states that a Z-score of 2.7 or higher means that the company was not is not at risk of failure. A Z-score of 1.8 indicates a high risk of failure. A Z-score between 1.8
okay. A
and
Z-score below 1.8
okay
indicates high risk of failure. Is that not?
Yes.
yeah.
Yes.
So what will be your conclusion for company C?
High risk of
High
failure.
risk.
High
That's it
risk.
now. You just put the comment there. Company C is at a risk of corporate failure. Management need to take urgent action to avert eventual collapse. Company C is at a risk of corporate failure. The management need to take urgent action to avert or to prevent eventual collapse of the company. What are the usefulness of this model? What is the importance of Z-score model? It draws attention to its uses key financial ratios. 5 key financial ratios. To draw the attention of management to the health of the company. One usefulness of this model is that it uses 5 key financial ratios to draw management attention to the health, to the financial health of a company. Limitation of this ratio is that it only focuses only on financial performance. It uses financial data only. Financial data are historical in nature. Financial data are subject to manipulation. Financial data is vulnerable to manipulation. The company should look at other non-financial factors. All right. We are done for today, for tonight. Any question, please? Okay. We shall be calling this a good night. May God give us a better understanding. Please, it is good to be consistent with the class.
Mr. Siwaju, I dropped the question on the chat bar.
Okay, I didn't look at it. What was the question, please? Let me see. Please assume nominal value. Nominal is 2 naira. What will be the market value for company C? Assume nominal is 2. Can you explain that, David?
Okay, yeah, that's just if the nominal is 2 per share, 2 naira per share, what will be the market value?
Okay, assuming the nominal price per share is 2 naira. You know what you need to now do is you take this 180 to get the number of ordinary shares. 180,000 divided by 2 naira. That means number of ordinary shares is 90,000 shares. Is that clear, please? When you get the 90,000 shares, now multiply it by the market price per share. To get number of ordinary shares, let me state it here. Because it's very possible that nominal price per share may not be 1 naira. To get number of ordinary shares, let me put a note here. Okay. Number of ordinary shares calculated as notes. Notes, number of ordinary shares is calculated as total nominal value, total nominal share capital divided by nominal price per share. For example, company APSC is equal to, for APSC, total nominal value 240 divided by 1 naira. Number of ordinary share 240,000 shares. BPSC Total nominal value, 300,000. Nominal price per share, 1 naira. Number of ordinary shares, 300,000 shares. Company C. Total nominal value, 1.8. Number of ordinary share, 1 naira. Number of 180,000 shares. David, I hope this is better. It's clearer now.
Yes, sir.
All right. I'm not sure there's a group created, yes. Otherwise, I will have shared this material with you guys.
Ah, that one error. Make una create it now.
It's not error now. The question is, have you registered?
Yeah.
So
you can put
the
it on
material is
the
available. All right,
How
let's
much is
stop
the
it here.
materials?
We can always chat on the group chat. If you're on that group chat, you can drop your comments or your concerns. Management will respond accordingly.
So
May
you
God give
mentioned
us a better
material.
understanding. Good night.
Amen.
Ashwaju, sir.
Hello, sir.
Yes, sir.
Please,
You mentioned material. Okay.
you can go
That's
ahead,
what
my
I'm
brother.
saying.
You
Okay.
can go ahead.
You mentioned the material is available. How much is it?
The material, is it available?
You said it's available.
Of course, it's available now.
I'm asking for the price.
Okay. Let's take it out. You have to drop a chat in the group so I can answer that question.
Okay. Thank you, sir.
All right. Let's
Mr.
take it
Ashwaju,
outside this video. Yes, please.
the group chat for PM is between you and Mr. Daoud. So I wish that you help us reach him before morning so that the group can be created before tomorrow afternoon and we can have all these materials there.
All right, sir.
It's well with you, sir. Thank you for the consistency.